All right. Good morning, everyone. Welcome in. Hope you guys had a great weekend. Today we have a guest with us from Investnet. His name's Michael Salduti. Michael is a practice solutions director at Investnet, and today we thought we kind of switch it up a little bit and just provide a conversation around high net worth clients, what your high net worth clients are expecting today, what segments are being underserved or where gaps there are within the high net worth space, and then just have a general conversation on what advisors and Investnet are doing and suggesting for advisors to make themselves a little bit more marketable towards those high net worth investors and even those where there are gaps in segments being underserved. And then also talk through some of the challenges and considerations within that space as well. So today, this is just a brief conversation around the high net worth space. As you may have seen in the invitation that was sent out from home office, we are providing 1 hour credit for continuing education if you are a CFP or SEMA designated. So from here, I'll just pass it off to Michael and we'll get the conversation started.
Thanks so much, Marcus. Thanks everybody for having me on. Put that up, Marcus. You can see that we're all good.
All good.
All right, awesome. Thank you again for having me on. So yeah, as Marcus said, this is a high net worth session that we're going to go through. We can provide 1 hour CE credit. So at the end, there's going to be a barcode, and you'll just scan the barcode with your phone and then log in your information that way. And then it says allow about 4 weeks for it to be applied. So there you go. We just ask that you sit through the whole session, try and stay awake. I'll try and keep you awake. I'll try and make this fun and not terribly boring, as some slideshows could be. So we'll see what we can do. I'll pick fun at my kids and my parents a little bit, and we'll have fun with it. So the presentation is called An Opportunity Within Reach. Something that we all have to really start to consider right now is that there is a transfer of wealth taking place that is $84 trillion, right? So $84 trillion of wealth is going to get passed down over the next 20 years. And it's important that we start thinking differently about the clients that we're serving, because as you're going to see and as we're going to talk about, the different generations are looking for and expecting different things from their advisors. There were 6.6 million high net worth households in the US in 2020, and this year there's about 8.8 million. So that number is growing. So to capture the opportunity, we need to understand who we're dealing with, how to attract them, and then finally how to retain them. And that's some of the stuff we're going to go through first. So one of the things we're going to do is we're going to take a look at the different wealth bands, and we're going to look at the different generations. And what we did is we broke the wealth bands down into 3 groups: 1 to 5 million, 5 to 30 million, and then 30 million plus. And then we're going to take a look at the generations. And so, as I said before, not only just for the transfer of wealth, but as people do generate wealth, right, especially in the time we're in with digital high net worth investors coming into play, younger generations are kind of selling their internet businesses, if you will, and gaining more wealth. And so I bring that up because we're going to look at the different wealth bands and generations, but almost look at it like a grid, right? So if I have a $1 to $5 million client that's a millennial, I'll treat them differently than I would, say, a 30 million plus baby boomer or whatever. And you can kind of mismatch the sets there. So let's kind of dive in. What we're going to do is we're going to look at the wealth bands first. We've got Millionaire Next Door. That was the 1 to 5. You've got your mid-tier millionaires, which was 5 to 30, and then your ultra high net worth individuals is 30 plus. So what we want to do is find out what their characteristics are. Who are they, right? And then secondly, what do they want? So when we look at the $1 to $5 million millionaire next door, if you will, 88% are self-made. They're college graduates and they're savers. So this group primarily put money away in their 401k and had mutual funds or ETF investments and just kept socking money away, and now they're millionaires, ready to retire, whatever the case is. So they kind of did it on their own. So really, what this category is going to need or wants from you is for you to clearly define your value proposition, right? Why do I need you versus I'll just do it myself? I've done it myself for all these years, and I've made $1 million. So what's the plan? So having a value proposition becomes extremely important. That goes for every wealth band, but the value proposition per wealth band is going to change a little bit. But for them, it's really bringing on that holistic approach, right? They want to collaborate through technology, real-time financial planning, being able to see all their assets in one spot, that kind of thing. And then take time to educate them on, the financial plan itself, why they need it so badly, how it's going to set them up for the future and help them retire moving forward. Then we get to our mid-tier millionaires. This is a 5 to 30 million. It's the most underserved group that's out there. Most of them are business owners. 45% are not prepared to pass on their wealth. That's probably the most important statistic on all of this. A lot of them are business owners that are really wrapped up in their business, right? They're entrepreneurs. They're just running with their business, and they're not thinking too hard about their personal life. And they have no idea how to pass down their wealth. They haven't really looked at any of that because they're so incorporated in the things that they're doing now, growing their businesses, selling businesses, buying new businesses, jumping up to that $30+ million tier. So this group really needs the help. You got to tie them down. You got to get in front of them. But when you do, educating them is going to be a big deal. About 25% have offshore investments or international exposure. But basically, they want an advisor that's going to collaborate across third-party providers, right? So they want to know that you've got a network of people. If they need to have trust set up, they want to know that you've got lawyers that you're working with, that you're partnering with, that are going to help them set up those trusts. Whatever the different nuances that they need in that space, they want to make sure that you're part of it, right? They want you to be their main advisor, looking at everything and kind of bringing it all together for them. They want transparency, and they want an institutionalized wealth management process, right? For this group, we start thinking about separately managed accounts. And separately managed accounts give them transparency. They see the stocks they actually own. They see the fees they're paying, and so on. And then, they've got the ability, or you'll have the ability to help them with tax management and so on. And we'll talk about that in a little while. And then we get to the 30 million plus, right? And so they're not really big enough yet to have a family office, but they're big, and they're going to need you to have a really big network as well. They're driven, they're self-disciplined, they're self-made people, business people, CEOs, entrepreneurs, and so forth. They want to generate income from their assets, right? Because a lot of them have all their money tied up in their businesses and don't have a lot of free cash flow. So they're looking to generate income off of the assets that they have. They're directed by they're impacted by political policies like taxes. Interest rates go up, interest rates go down. That's a big deal. Tariffs, big deal. So they need help. They need help kind of digging through the noise that's out there, but they also need you to have a big team, and they need to know that you're focused in on that space. Tax planning, estate planning, all very big. If you don't do estate planning, right, having that estate planner as part of your office makes it a big deal. And then protection, liquidity, volatility. I mean, they're used to taking risks. They don't need to make millions and millions and millions of dollars. They need protection. They want to protect what they've got, right? They want to protect against the volatility that maybe their business itself brings. So if you think about it, if they're all, kind of tied up in the business that they're in, and they're taking risks if they're owning their own businesses or whatever, they're used to taking that volatility in that space. They don't necessarily want to take it when it comes to their investment portfolio. So things to consider there. I've got white papers that I'm going to send out that dig deeper into all of these. So you've got it. We've only got like 40 minutes, so I can't dig too deep, but just know that I will send Marcus the white papers that go over this segment. It also goes over the generations, which we're going to get into next. So we looked at the wealth bands, and now it's the different generations that are out there. And so you've got the baby boomers, which are my parents. You've got Gen X, that's me. You've got your millennials. Basically, all my friends are millennials. And then Gen Z. So I've got 4 Gen Z kids, so I know that group pretty well. The things we got to know about the different generations we're going to get into, but something else that I want you to bring to mind is that the way that each generation establishes trust is a little bit different. Baby boomers control 51% of the total wealth in the United States today. So I'm imagining a majority of your books, unless you're a younger advisor, are baby boomer assets. So it's a good thing to think about, right? How much of your book is made up of baby boomer assets? Because knowing that, you know, the oldest baby boomers are already taking income and so on, but the younger ones are going to start doing it soon too. And so that money's going to start walking out the door, if you will. So understanding the children, understanding the generations afterwards that hopefully they're going to pass that money on to is important, and hopefully you've got relationships with them. They're the biggest spenders, right? They're spending money on their grandkids, they're going on vacations, doing all that fun stuff, and they're self-assured. What do they need? They need a personal relationship. They need clarity, and they want a holistic approach. My father, in order for my father to trust you, he's going to have to meet with you. He's going to have to sit down. He's going to have to look into your eyes. He's going to want to shake your hand. He's going to want to go to your office, and he's going to want to see your office and see that it's, you know, in the corner and you've got nice furniture, all these things, right? And it's not because he's a superficial person, but it's because it's how he learned how to trust people. He didn't have the internet to go to when he was younger to Google somebody to see how many likes they had. He had to meet with them. He had to get a sense of, I can trust this person. And so for the baby boomers, that was a big deal. And for my dad, that is a big deal. So he wants that personal relationship, but he's going to suck up your time. So you got to be ready for that too, because he wants to talk to somebody other than my mother. And since he retired, that's all they do. One of them's going to kill the other at some point, but they're looking for those personal relationships, right? They need clarity around all the noise that's out there. My dad calls me constantly asking me about cryptocurrency and the latest thing that he heard about on CNBC. And I got to kind of explain it to him, and that holistic approach, bringing it all together. So those are the baby boomers. A lot of that wealth from the baby boomers is going to get passed down to the millennials, but some of the Gen X, because a lot of the baby boomer children are millennials, but as I am one of the Gen Xers, my parents are baby boomers. So on the Gen X side, this is really your financial planning clientele, right? More income, more debt, and larger expenses. So as you all know, I've got my parents who are both alive, and they're doing well, thank God. But I worry about them. And so I've got them to worry about. And I've also got my kids to worry about. So I've got, as I said, 4 Gen Z kids. So the Gen Xers you could consider as the sandwich generation is what we're called by some. And it's because we've got those aging parents we're worried about. My parents specifically don't have a lot that they retired with. So there's going to be a financial burden on myself and my kid and my sisters. And so that's a worry. And my kids are growing up. My oldest is 20. My oldest is 20. My daughter is 18, and then I got a 16 and a 13. So we're talking about college and expense there. So Gen X is really your financial planning client. They're the ones who need help. They want security. One of my big things was getting disability insurance. I needed to know that, God forbid, I can't work anymore, because I already had life insurance. But what happens if I can't work? I need to make sure that I've got some kind of income coming in, God forbid that happens, right, from a disability. So for me, that was huge. And that's the security that I'm looking for. And that was all done through financial planning and discovery. I want support, but I want a flexible relationship. See, my dad wants to go in and sit down with you, whereas I don't really want to come into your office necessarily. I want to be able to do a Zoom and meet with you that way, mainly because I just don't have the time to come into your office. So that flexible relationship becomes important. The millennials, 73% are actively saving, 51% are concerned about debt. When you think about millennials, their biggest debt is their student loans, right? They want to get that stuff paid off. They are saving, but they're results oriented, which is good. Millennials want to be included in every step of the process. They want to be part of the plan. So, I keep talking about financial planning because going forward, that's going to be the most important thing. When it comes to millennials, the Gen Z specifically, I already talked about Gen X, but it used to be just worry about my investments and just take control of that. These younger generations want to have one person to go to, and they want to talk to you about everything. I know I'm like that. My advisor has everything, my life insurance, all that stuff, all in one place. I could care less what mid-cap growth fund is in my portfolio. Don't care. I don't want to know. I just want to know that I'm hitting my returns that I need to hit. And if I'm not, are we going to make an adjustment and move on? Because my investments aren't the most important thing to me. And as you go down the line, investments are obviously an important thing. I'm not saying they're not, but collaboration is a big thing, is a big deal. So easy access, collaboration, and that holistic approach is very big for the millennials. And then finally, you got the Gen Zs. These are my kids. They lack investment knowledge. My nephews, I was just with them recently, and they're making a little bit of money, not a lot. My one nephew is a coder, and he makes like $70,000 a year, and which is good for him. It's good for most people, but he's like, "What do I do with my money?" They come to me constantly. What do I do? And they're always asking me about cryptocurrency. Should I put it in there? And, you got to kind of walk them through. What do you want this money to do? Are you going to touch it? Are you going to look at it every day? Those kind of things. So they see on TikTok, because that's where they get all of their information. They see on TikTok that there's people making tons of money on, in crypto. And then, all the XRP blows up because somebody said XRP is going to go from $2 to $100 tomorrow because this is going to happen. But as you know, if you get into an algorithm that tells you that starts talking about cryptocurrency, it's the only thing you see. That's the only thing they see, and it's all they're focused on. So you got to educate them and broaden their knowledge, right? They're the generation that's looking for that work-life balance. They want to make sure that they're very worried about their mental state as much as their workspace, and they want to be comfortable in a lot of things they do, and they're skeptical about everything, right? Especially now with AI. My kids could pick out AI like that. I can't. I thought I was good at it. I'm not. I'll send videos to them and they're like, "Dad, that's AI." I'm like, "Oh, all right, my bad. I thought it was a little too cool." Anyway, so they're skeptical. So the idea here is they need education, but they're going to do their own research, right? The oldest Gen Zs are 25 years old, I think, right? So my nephew, who's a Gen Z, is now a financial advisor, and he tells me all the time when we talk about being skeptical, like his friends already know what they want to ask. They're doing the research, and if he gives them a suggestion, they're going home to look it up to make sure that what you're saying is true. But then they're going to go find opposing articles as to why they shouldn't do it. So there's a lot of things out there, right? So they want advice based on facts, and they're looking for that long-term approach. They want to stick with whoever it is they're with for the long run. All right. So how will the generations evolve? How do we attract them? And what are some of the segments we can look at to attract them? So here's 4 that we came up with. This was from Forbes.com. Some of the underserved segments. Henrys are the biggest ones, right? So a Henry is a high earner, not rich yet. And so you think about young lawyers, young doctors, just young professionals in general that are making $100,000 or more, but don't have that $1 million yet, right? They're not there yet. When you consider your book of business, especially if you're an older advisor, I would highly suggest teaming up with a millennial or a Gen Z financial advisor to bring these kind of clients in if you don't have them already, or make it a point to start seeking them, right? Because as the money's leaving from the baby boomers, this is the new growth. This is the new dollars that are coming in. The other one, you've got women will inherit 70% of the global wealth over the next 2 generations. And ladies, I think you all probably will agree with me. Women tend to like to work with women. And so there's a lot of women in this space, a lot of female financial advisors who have and specifically work with divorced females or females in general. And it is a big niche and highly appreciated, or it's very appreciated by the women out there that they're working with. Then you've got tech wealth. That's what I was trying to get at earlier. The tech wealth, high net worth individuals, right? These are the kids out there sometimes, building things in their garage and selling it for $1 billion later on. This is a space that if you're not in it or not familiar with it, it's going to be somewhat hard to get into. But in any of these cases, or most of them, well, maybe just this one, becoming part of a group, right? Finding out where they all kind of collaborate and joining groups to get in with that space. A lot of the Gen Zs and millennials are already part of these groups. And so, that's kind of the best way to get into it. Same as the LGBTQ plus community, 62% say they have their own unique needs that influence their choice of advisors, like adoption, estate planning, and so on. There's a lot of segments out there. There's 4 here. But if you're newer to the business and really just starting to kind of come up with a niche for yourself, it's something important that you might want to take a look at. So be easy to find, right? Be online. You have to have an online presence now, right? I told you before, my dad's probably not going to go online to find out what your reviews look like, but I will. My kids certainly will. All the other generations are going to do it. So being online is important. The other important thing about being online, and when we talk about millennials and especially Gen Z, if you're involved in a certain area or you're giving back or you do a lot within your community, let that be represented on your online presence, because those things become very important, especially, well, I say especially for the Gen Zs, because like I said, I'm surrounded by them with my own children, and I know how important it is for them to work with somebody that's aligned with their values, and to work with someone in general who has values and they're posting them online. It becomes a big deal. Paid opportunities, that's digital marketing, right? Any way you could do digital marketing, getting ads out and so on. And then finally, events. This could be like a Mother's Day brunch or a Father's Day fishing trip or whatever. But the client appreciation events have somewhat gone away right after COVID. I think they're starting to come back now. But if you do them right, they're really, really effective. And so there's a lot of ways you could look at, how to do an effective client appreciation event online. There's just so many different cool ideas that are out there. So the other thing is you're going to have to worry about or prepare to address any objections. Fees and self-management are going to be the 2 that you're going to have to overcome. 72% of high net worth clients expect to pay $5,000 or less annually. Think about that. That's 50 basis points on $1 million, right? That's like saying I want a filet mignon, but I'm not paying more than $10 for it. It's a little off. So we have to have that value proposition. What this tells me is they don't know what the value of the advisor is, and we have to be able to articulate that and know that well. Here at Envestnet, we've got a ton of information on value proposition. If you ever need it, want it, get to Marcus, come to me. I've got a lot of it, and I'm happy to walk through it. It's something I've kind of tried to specialize in over the last 20 years I've been here. So anyway, value proposition becomes a big deal. So 59% of high net worth investors do think they will, or do not think they will hire a financial professional. And the reason is they want to handle it themselves and they're confident in their own ability to manage their own money. And this can be overcome by an easy conversation, right? Many of them prefer to handle it themselves, have been doing what I said earlier. They're the ones who've been stocking money into their 401k and increasing that money. So understand why you can't handle it yourself, number one. And number two, anybody with emotions tied to anything are not going to be great at managing their own money, right? If you're emotional about your money, which everyone is, then you're going to get in at the wrong time and you're going to get out at the wrong time. It's just what's going to happen. It's what happens all the time. It's why they tell surgeons not to operate on their children. They're too highly invested in it. And so simple conversations, I think, can overcome some of these objections. The other thing is you can show your value through some of the through the evolution of investments, right? So if clients are used to stocking money into their 401ks with mutual funds and ETFs, that's what they know from the investing world. Most of them, and a lot of financial advisors don't know that much about separately managed accounts. So being able to broaden the horizons of the clients in that conversation. Look, Mr. and Mrs. Jones, you've accumulated a lot of wealth. Now that you've got X amount of dollars, $1 million plus, and a lot of it being non-qualified, one of the things you might want to look at are separately managed accounts. So separately managed accounts, if you don't know what they are, just like a mutual fund, except the client owns the individual stocks. So if I have XYZ mutual fund, a lot of times XYZ mutual fund has a sister XYZ separately managed account. And in the mutual fund, if we all buy that mutual fund together, we're pooled investors, we all own it. If I buy the sister separately managed account, the stocks in the portfolio are mine, and the cost basis starts when I buy into it. So when we talk about tax efficiency, mutual funds are not that tax efficient, because if we are all pooled investors and there is a capital gain at the end of the year, your capital gain might be bigger than mine, but we all have to pay the same one at the end of the year, right? And so those pass-through gains, there's nothing we can do about it. With the separately managed accounts, you don't have to worry about that. Because the client owns the stock, the gains or losses are going to be theirs. So helping them get to that. The other nice thing about owning SMAs is the fact that the clients can restrict stocks if they wanted to. They can do tax loss harvesting. They can even restrict sectors if need be. Think about a business owner that's got, they own car dealerships. Well, maybe they don't want automotives in their investment portfolio, so you just exclude the entire automotive industry from their financial portfolio. It kind of insulates them from that. And then finally, the next thing that you're going to hear a lot about, because it's all over the place, is direct indexing. Direct indexing are separately managed accounts that mirror an index. So think of it as an ETF, except that the client owns the individual stock positions underneath. So if you're going to, at Investnet, we have what's called quantitative portfolios, the direct indexing solution. So if you wanted to invest in, say, the large cap core index, there might be 1,000 securities in that, right? The Russell 1000, but in our portfolios, you'll have 150 stocks. So they kind of mirror the styles and everything else to match the index. So you should have index-like returns, and typically they're cheaper and they're easier to help when it comes to tax transitions. And again, any other information on any of this stuff, I can help out. This chart's one of the most important ones in the presentation. And essentially what it is, it's a spectrum study that was done in 2021. And the light blue bars are what clients are actually wanting from financial advisors. And the orange is what they're actually getting. So financial planning, 92% say they want it, and 59% are actually saying they're actually getting that. They're getting financial planning. The big one that stands out after all we've talked about today so far, 93% want wealth transfer advice, and only 17% are getting it. All right. This was done in 2021. It wasn't as big a deal, I don't think, back then. I know it was only 4 years ago, 3 years ago, but it's becoming a much bigger deal, and you're going to hear a lot more about it as people do presentations. that wealth transfer advice is huge. Investment management, trust services. Again, for a lot of these things, you might not do trust or whatever, but having a network of people that get into trust and do it is extremely important, because I don't want to have to go to you and then you tell me, well, you got to find a trust attorney. And then I got to go research trust attorneys. And then I got to find one I like, and I got to look at all their likes. If I like you already, I trust you already, and you tell me to call so-and-so, I'm going to use your trust in that person as a stepping stone. Like, all right, perfect. I'm just going to use that person because I like you and I trust you. And so having that network is important. Tax planning advice has become a lot easier, right? So tax planning advice could be as simple as when to take money out of what account, right? When to activate your annuity and let your investments run, or let your investments run and leave the annuity alone. Take out of the Roth before you take out of your regular IRA, those kind of things. But then the other part of tax planning, which has become easier, is tax loss harvesting, being able to do tax overlay, those kind of things. We have programs that are available to you that could dig into that as well. And then it kind of goes down the line. Loan and credit management, when you start talking about those top tier high net worth individuals, the 30+ million, that's a big deal. They'd rather take a loan at a really small interest rate than start knocking into their investment portfolio to go buy something. So all those things become a big deal. And again, we can get this stuff out to you. 91% of high net worth individuals under 40 years old have investments in digital assets. Most broker dealers don't allow you to invest in digital assets. It's an unregulated market. And so I'm not saying that that's something that you should be thinking about. What I am saying is that just like when my nephews came to me and started asking me about cryptocurrency, I should have some kind of an idea. And I should be able to educate them on, hey, if you want to put money in there, what I would suggest is putting it in there, leaving it alone, don't look at it, and just let it go. Expect to lose it, but hopefully it goes up. And then you can get into the rest of the financial planning conversation after that. But having some kind of a talking points it becomes really important. 39% of millennial high net worth individuals switched providers in the past year due to the lack of transparency. They demanded greater digital interaction, education, and convenience. So we kind of talked about this already, but millennials want to be part of the process. They want you to do financial planning. They want to see all of their investments in one spot, if possible, because it's going to help them make better decisions, right? I got that Rocket Money app because I saw the commercial. Do you know how many subscriptions you have? I'm like, no, I don't. And with 4 children, you can imagine I have every single one, I think. And so being able to see that in one space and be like, you know what, maybe we're going to get rid of some of these subscriptions, because when it was just $10 a month, it was one thing, but now $10 a month times 10, that becomes a different story, right? And then you start looking at the Starbucks transactions my kids started making. Things got a little out of control, but I was able to see everything in one spot and make educated decisions on going forward. Because a lot of times we think we got to make these big sacrifices to hit the goals we want to hit, but in theory, we don't. In general, we don't. We could just stop going to Starbucks, or at least take the card away from the kids. And now my older 2 have jobs. They can get their own. Anyway, I digress. So the other thing for retainees, have that hyper-personalized retention strategy, right? So the first one is deliver educational support. Current market outlooks and commentaries, having that stuff available, specific investing themes, and then appropriate product expectations, right? Which is the most important thing to me, is managing your clients and giving them expectations. So when you're presenting something to them, you know, you're showing them past performance. Look, that's great. This is what it's done in the past. But when we look at expected rates of return and expected standard deviation, it's important to explain to them what we're really trying to get out of this portfolio is 6% a year, because that's what you need from your financial plan to move forward. If we do better than that, that's awesome. If we do worse consistently, then we got to look to make a change. but keeping their eye on the ball at that 6%, not the 15 or 20 that maybe that it did over the last year or whatever. So giving them those expectations and learning them and teaching them that it's time in the market and not timing. The next one's the personalized tax management. Again, you could do this through separately managed accounts by tax loss harvesting. You can look at different allocations to address tax concerns. There's fund strategist portfolios out there that are tax efficient that you can look at, and then buy and sell strategy that's appropriate while buying a diversified portfolio. The third one is expanding product knowledge or expanding product set is really, I think, what it said. This is a big one. So a lot of advisors, especially advisors who have been in the business for a long time, enjoy building their own model portfolios, and a lot of their value comes from that, right? I'll talk to advisors all the time and say, look, I do my own portfolios, I manage them myself, I beat all the fund strategist portfolios that are out there, yada yada, right? And at the end of the day, we did a study, and while some advisors do beat those fund strategist portfolios, a lot of times they're taking more risks to do it. And I'm not knocking anyone who's doing this. All I'm saying is it might be a good idea if you're doing this for every single client, because the average advisor spends 800 hours a year. That's 2 days a week when you break it down. Maybe one of the things you look at is, hey, for my top clients, I'm going to do this because I really do deliver a lot of value when I build out my own portfolios. But yes, it does take a lot of time. So maybe for clients that have $1 million or more, or whatever you decide, you're going to build out model portfolios for. But anyone below a certain dollar amount, you're going to, and what you're going to find is when you outsource those lower tiered models to BlackRock or American Funds or whoever, it's going to save you a lot more time. Outsourcers added $14.5 million to their assets annually, which was twice as much as anyone else. And they also added 14 new clients a year versus just 4 for those people who do things on their own. And again, that's because of the time that they're saving. So the value proposition used to be, give me the best performing portfolio, and that's why I'm hiring you. Now I think that value proposition is changing as we move down the generational lines, because the baby boomers wanted you to build their own stuff. They wanted to brag about it. But the millennials, the Gen Zs are really looking for that holistic approach. They don't really care too much about who the large cap growth manager is in their portfolio. So it's something to consider. Use actionable data. 76% of high net worth individuals under 40 list ESG as an important investment objective. That's also something that's starting to change, right? They're starting to think about values-based investing. And for high net worth clients that can use separately managed accounts, at Envestnet, you could do a values-based overlay, right? Where you could tell the managers, we don't want alcohol, tobacco, firearms, whatever it is. There's a environmentally friendly screen out there. What I would say is, don't go in with your own biases to a client who asks you about adding a values overlay. Because if you've been dealing with baby boomers for a while, this rarely comes up. But you're going to see it come up more and more. And I have a colleague of mine who his grandmother passed. She inherited money, wanted to do a values overlay, and the advisor said, no, we don't do that because you're not going to perform well and you're going to fire us. Well, she didn't hire them in the first place. So they let their own biases kind of lose that for them with data that's not even proven or real, right? I mean, so anyway, just know that that's out there, and that's something that's becoming very important. This should go without saying, but if you're only dealing with the husband and not the wife, 70% of widows fire their financial professional. It's going to happen, and women are going to inherit 70% of the wealth going forward. So again, If it's not happening, you need to be aware of that. It should be happening, but we need to move past having the husband and the wife at the table. It's got to be the husband and the wife and all the kids and anybody else who's going to be heirs to the wealth that's getting transferred down. So some things to consider. Some hot tips in all this. Set up an annual process to address beneficiary designations, ensure assets are transferred as intended upon death, making sure they've got that plan in place. Ensure you speak to multiple family members on an annual basis. And then finally, high net worth individuals are looking for that family office. Again, you're not going to do this for every one of your clients, but having a family office approach as you get to those high net worth individuals becomes a big deal. So book segmentation is really where this comes into play, right? Access to sophisticated investment options, an approach that positions your client as the top priority, an offering that is customized to address their needs, and a team available to assist any family member. And maybe that's your top 10 clients or whatever, right? But looking at your book, segmenting it, and creating kind of a sequence of service per segmentation helps set those realistic expectations going forward. So if you build it, they will come. Grow your high net worth business. So ID your target market and client segmentation, understand who they are, attract them by meeting expectations, by delivering a personalized experience, and then retain them from forming deep relationships and anticipating their needs. And you've made it to the end. So again, I've got some white papers on this. I will send them out to Marcus so that he has them, and he can send those white papers on to y'all. And he knows how to get in touch with me if anybody has any questions about this, wants to dig into some value proposition stuff. I'm readily available and here to help out. So with that, I will pop it over to you. I'll leave this up for another second if you want.
Yeah, you can leave it there. That's fine.
Okay.
Yeah, thanks. Great job, by the way. I thought that was great, and I thought this is really helpful. And for those on the call still, just wanted to bring Michael on to get this topic of conversation flowing through you guys' minds as we kind of wrap up the year here. So if there was anything where something stood out to you that maybe a gap or something that's not at your strong suit today in terms of portfolio management for your high net worth clients, such as financial planning, maybe there's a gap there. If you're interested in learning more about the options that are available to you and that we have a relationship with at the home office, please feel free to reach out to me. We can help you find a solution there for financial planning. Also around the SMA opportunities that you have for portfolio management for these high net worth clients as well. Please feel free to reach out to me to just learn more about the SMA process and even UMA process. So UMA, we've seen 34 or almost 36% growth year over year here at StoneX. So if you don't know what a UMA is where you're able to use multiple SMA managers and maybe add in a FSP manager to create a greater personalized portfolio for your high net worth client to get them that really personalized feel of portfolio management for them, and then using the tax overlay to manage the high net worth clients' taxes as well. So all those things that Michael touched on today, if there's any questions, anything that I can help with, please feel free to reach out. But with that said, I think we don't have Q&A scheduled. So if anyone has any questions, just feel free to email me and we will take it from there. So thanks again, Michael. Just want to say great job again. This was really helpful and looking forward to working with you more in the future.
Thanks everyone.